All right, everyone. Hey, thanks for joining us tonight. Um, we're going to just go ahead and get started. I want to respect your all's time and keep this right at or under an hour and get you guys as much information as possible inside of that time. And then we'll go from there. If you have any questions throughout this webinar, feel free to just put them in the chat message. I will take time at the end as well for some Q&A. So we can ask questions at the end too. But feel free to pop them in the chat box as well as I'm talking, and we'll try to get you answered. So I'm going to go ahead and get started. My name is Jason Powers. I have kind of this eclectic background in real estate investing, wealth strategizing. I've owned several different businesses over the years. And I started out, in the real estate game a long time ago doing some fix and flips and wholesaling and got into rental properties a little bit and kind of have upgraded over time and bought an RV park, a former RV park a couple years ago, and been renovating that and getting that built back up to its former glory. And so I know this space a little bit, but my passion is what I'm teaching you guys tonight. I've been doing this as a career for a while. I was practicing this before I got into this as a career, and I love it. I eat, breathe, and sleep it. I hope you guys see it tonight and understand it and love it as much as I do as we go. So I'm going to dive right in. Before we do, I do have to quick disclaimer. This information is not legal or tax advice. Seek that through your own resources, but what we're going to tell you tonight is accurate and it's great. So I like to say we are private family banking systems experts, designing personalized strategies for individuals, families, businesses, nonprofits, and through education and strategy planning, help you come up with a customized approach to implement your own private family banking system. And so as we go tonight, I'm going to pause this and get my slide deck reset. As we go tonight, I'm going to spend some time educating. I need to set the stage, teach you kind of what it is, why it works, and then I'm going to give you some actual examples on how it applies. And then as we go, don't get caught up in the numbers. Think about how can it apply to you in your situation. I always like to say, what would your life be like without the bank? What would life be like if you never had to borrow money from an outside bank again? What if you could be the bank? This privatized family banking system, it's called different things. Be your own banker. We like to say wealth without Wall Street. Finance your own deals in the real estate world. The infinite banking concept is what it's truly called. That's what we are teaching people how to do, this infinite banking concept. So let me ask you, what keeps you up at night? If you own an RV park, maybe it's like everybody else. It's interesting. 77% of Americans are anxious about their financial situation. There was this report, this study that was done by Capital One about 2 years ago. It showed 58% of Americans feel that their finances control their life, and 68% are worried that they're not going to have enough money for retirement. If you're self-employed, some of that stress is even larger because we're so dependent on the businesses we own, and how is that going to finance our retirement? And as that study showed, retirement is the chief money-related worry. Right? Cost of living, 56% worry about that. 45%, half of the people worry about debt, which is normal. So when it comes to your money, what would you like to do with it? How much would you like to have? When do you want it? But the big question I like to ask people is why? Why do you want the money? What are we trying to accomplish in the end? Nelson Nash says, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years' time, 97% of all the money would be back under control of 3% of the people. Well, why is that? Well, it's because they understand money and how to get it to flow to and towards them instead of away from them. And that's what we do. That's what we teach people is like, how do we get money to flow towards us instead of away from us? We're constantly we finance everything we do, right, in life. Let me ask you a couple questions. Don't answer. Think about it in your head. We're going to circle back around to these answers later. Would you rather pay taxes now or would you rather pay taxes later? Defer taxes. Next question. If you had $30,000, would you make more money loading it out on a 5-year loan at a 6% amortized loan to somebody? Or would you make more money putting it in a CD at 4% for 5 years? I'm going to tie that in later. And do you think taxes are going up or down in your lifetime? It's not a trick question, I promise. So what's the problem, the financial problem? This is a snapshot from yesterday of usdebtclock.org. If you've never been to this website, check it out. It's usdebtclock.org. It is fascinating. It's also depressing. It shows live rolling numbers of U.S. debt in various sectors. And you can see, I'm going to get the highlighter out here if I can. You can see U.S. total debt skyrocketed. Personal debt. What do we got? We got Social Security, DOD, Medicaid, and the numbers are just going up and up and up. Credit card debt is up to $1.1 trillion with a T. Student loan debt 1.7. And it's a problem. And it's not really going away anytime soon. And these numbers just keep going up and up and up and up. And we're one of the unique countries that think if we spend more money, this number will go down somehow. If we print more money. I'm not going to get into politics tonight, I promise. But anyway, it's fascinating. So how do we, as an individual, change this trajectory for ourselves? How do we get out of this and get ahead? Like Albert Einstein, he says, we can't solve problems by using the same kind of thinking we used when we created them. So there's 3 types of people, okay? There's the debtor. This is the overwhelming majority, probably. That's those of us who like to finance things. We like to, say a car. We're gonna finance a car. We're gonna pay it off over time, get back to zero. We're gonna go back and finance another car. Pay it off over time, go back to zero, and so on and so forth throughout our life. The opposite person is the saver, is the person that says, I don't want to go into debt over this. I'm going to save up until I have enough money, and then I'm going to buy that car. So they save up, they buy the car, go back to zero, they save up again for the next car down the road, go back to zero, so on and so forth throughout your life. You do this in a lot of different things, right? Either financing or saving. What I want to show you guys is how one can actually become what I call a wealth creator. It's where you create this financial velocity that can literally last for generations. If you keep teaching the next generation, this will carry forward and get larger and larger each generation. Where do we put our money? Well, the primary place we put our money is banks, right? So let's talk about what banks do for a minute. These were actual numbers from Bank of America a couple years ago. They took in $909 billion in deposits. They paid $3.1 billion in interest back to its depositors, right? You put your money in a savings account and you get an interest return. Right now it's highly non-impressive. But then they made almost $50 billion off of the rest of the money. How are they making so much money? Well, they're the bank. There's a thing called fractional reserve banking. If you've never heard of it, it's legal. The Fed says basically, as it's presented to the public, they say, hey, the bank has to keep 10% on reserve on average, right? It depends on the size of the bank, so it can run anywhere between 9 to 12% in general. But they say the bank has to keep 10% on reserve, and we say, okay, that sounds good. Well, what it actually means is 90% of the deposit can be loaned out to someone. So if you deposit $1,000 in the bank, they're going to keep 100 of it on reserve, but they can loan 900 of it back out. And so they do that. That 900 goes back into a bank, right? And then that bank keeps 90 and loans out 810, 90% of it. That 810 goes back into the banking system, 81 on reserve, 729, so on and so forth. And by this point, this many times over, there's 3,400 in the system, but the bank actually only has $271. That's fractional reserve banking, and that's why if you were around in 2008 when everything was crashing, there was a run on the banks, and people were going to the banks and they were trying to get all their money out, and the banks were literally locking their doors. We don't have it. It doesn't exist. There is no money here. There's not enough. Conversely, FDIC, we say, oh, what's an FDIC insured bank? Well, if you look up total deposits versus total coverage, that the FDIC coverages is a little bit less than 50% of total deposits. So either way, there's just all this phantom money out there. But to a point, which I'll talk about in a little bit, that $1, each dollar that's in the bank is doing a few different things at a time, right? The money that goes in is doing several different things at once. Where else do we put our money? Investment products, qualified accounts. Let me ask you what qualified plans do. Right? They defer the tax and they defer or postpone the tax calculation. Okay, our retirement accounts, right? Our 401ks, etc. Let me ask you, let's go look at it a little bit differently. Let's say you wanted to borrow $10,000 from someone. You would ask two questions before you took the money, right? You would say, how much interest do I have to pay and when do I have to pay it back? Well, if that lender responded and they said, hey, we have enough money right now, so we don't need a payment from you, but there will come a time when we do. When we know how much we need, we'll be able to determine how much interest we have to charge to get the amount we need. Let me say it again. If they said, hey, we have enough money right now, we don't need any payments, we will know down the road how much we need. We will know how much we're going to tax you down the road. Once we figure that out at that point, we'll let you know. Would you cash that check? Most of us would say no, no way. But that's exactly what we're doing with our qualified accounts, right? Our deferred tax accounts that we're going to retire on, and we're going to hope the year we retire is not the year that the market crashes, right? Or any year thereafter that our money's sitting in there. There's a place for it, but that's the risk that we're taking because most of us, we don't know any different, right? That we're taught through our whole life, work hard, put money into a retirement account, and live off that retirement. But that retirement account, they have traditional models of that. I'm not here to sell you a retirement account. I want to show you a vehicle that can show you income tax-free growth, access to your money now where you're not penalized to access your money, a competitive rate of return, uninterrupted compounded growth, which I will talk about. It comes with various other long-term care benefits, creditor protection, collateral opportunity. You get to pay yourself. Also creates a legacy, penalty-free access to your money, which I talked about, unstructured loans, liquidity, use control. It does all these things. And that is what I call the privatized family banking system, or the infinite banking concept. Okay. Now, Yogi Berra also, he says you've got to be very careful if you don't know where you're going, because you might not get there. And it's so true. When we follow the herd, so to speak, a lot of us, we just keep our fingers crossed and keep our head down, hope it works. If you're in the RV industry, you probably, when you first got into it, I'm guessing you didn't follow the herd. I'm guessing you did it out of passion. You did it out of belief that you can do this and you're doing something you love what you're doing. Others of you maybe are in the real estate investment game, and it's a good investment, especially once COVID hit, and it's been fascinating watching the industry boom ever since COVID. But so if you don't know where you're going, you might not get there. So I want to show you, kind of break this down, the infinite banking concept. What is it? How's it work? And what's it going to do for you? Okay, the vehicle through which we show people how to do this is properly structured whole life insurance that's dividend paying from a mutual insurance carrier. Now that's a mouthful. So properly structured dividend paying whole life from a mutual insurance carrier. So let me tell you why I'm wordy about it. It's because it's not just, hey, go get a willy-nilly life insurance policy and you can actually use cash value from it. It's not quite like that, although that's partly true. We say properly structured. It's got to be structured a particular way. There's a very specific way to structure these policies to maximize cash value access so that you can utilize it throughout your lifetime. Dividend paying from a mutual carrier and whole life. So I'm talking about tonight, I'll be talking about whole life insurance. I'm not going to be talking about term insurance, IULs, VULs, and these types of things. Dividend paying from a mutual carrier. It's because there are two types of insurance companies. There are stock-owned companies, right? Its interests are for the stockholders. And there are mutual carriers. So as a policyholder, you're actually one of the owners of the company, thus entitled to the profits, which come in the form of dividends. So we say dividend paying from a mutual carrier. I'll explain some of this a little bit. I'll tie it in, okay, as we go. But this is what we're talking about tonight. Whole life, don't be scared of it. This is the oldest form of lifetime level premium insurance. It goes all the way back to the 1700s. I shortened the name. It was started as the Corporation for Relief of Poor and Distressed Widows and Children of Presbyterian Ministers. That's actually a shortened version. It got started because ministers were spending their life in ministry and then retiring, dying, and the family was left destitute because they had been supported by the church all that time. And now all of a sudden the church isn't supporting them. And that's how it got started. It's been around for a long time. What companies carry whole life insurance, cash value whole life insurance? Well, big banks do. They carry billions of dollars in whole life. If you look at their balance sheets, which you can find if you dig around, you'll see it's a tier one asset and they own billions of dollars in cash value whole life on their executive employees. So we start perking up and we start going, well, why is that? Fortune 500 companies, these companies understand it, they get it. Lots of companies. There's a fun story on Walt Disney. He couldn't get enough of a loan to build a theme park based on a mouse. And he had this dream. And so he actually borrowed money from his whole life policy to finish funding this new dream. And look where it's at now. Ray Kroc, when he bought out the McDonald brothers, he actually borrowed from two different policies to pay some key employees and then start a marketing campaign on his newest mascot. Any guesses? Mr. Ronald McDonald. So it's fun. As you dig around, you start seeing who's using it. How about certain dignitaries? These guys knew about it. They know about it. Interesting article on Joe Biden when he had to disclose his finances. Talked about how he owns 0 investment products, but 6 whole life policies. He owns 6 whole life policies. Well, that's a head scratcher then, even more. We start going, what do these guys know? What are they up to? What do they know that we don't know? So I mentioned the term uninterrupted compounding. I want to explain this for a second, okay? We've heard of compound interest. Well, uninterrupted compound growth, it's the principle where something, in this case your money, and its gains are growing continuously on top of each other over time, okay? Interrupted compound growth or traditional compound growth, if we say it's compounding, it's typically interrupted. Each time you pull money out or your investment declines. So think of a retirement account. I'll show you. But I want to make that distinction. Uninterrupted compounding is one of the most important factors in what's going on with your money inside of a policy and why it's growing uninterrupted. Einstein again, he says, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. I'm going to come back to this question I asked earlier. If you had $30,000, would you make more loaning it out at 6% amortized for 5 years or 4% in a CD? Most of us at a glance are going to say 6% because obviously 6% is more than 4%. And I always tell my clients, I say, let's always do the math. Let's make sure the math is right, not just looking at surface numbers if we don't do the math. And if you're in an RV park space, I hope you're always doing the math, right? We're always doing the math. How many spaces do we have? How much are we going to charge per space? How many nights a week can we rent? How many nights a month? You know, 30,000 6% can make 34,799. 30,000 4% CD can make 36,629. Why does 4% make more than 6%? Well, the first one, the 6%, is amortized. So if you're familiar with your amortization schedule on a mortgage, you're paying that 6% on a lesser balance every year, right? The CD is compounding every year. So that gains add to the new total, and then it's 4% of the new total every year. So that's why 4% can outpace 6% in this example. So we always say, always do the math. I'm not here to sell CDs. Don't worry. I want to show you in another example, this interrupted compounding. This is actual numbers, S&P 500 performance over 20 years. For a person who started at 65 with $1 million in their retirement account and they were going to live on 75 a year, you can see the interest rates, how they went up and down over the years, right? This minus 38, that was 9/11, and so on and so forth. So this is just to show you it got interrupted in market declines. It got interrupted every time they withdrew money. So you started with $1 million, 20 years later, 255 left, okay? Let's dive in. Now I want to show you a couple of different examples here using dollars. Don't get sidetracked by the dollar amount. Everybody's situation is different. I have clients doing a couple $100 a month through their policies. I have clients doing 300,000 a year through their policy, and everything in between. So the dollar amount is not important right now. It's the concept. What is it doing, and how is my money working, and how can I use that money for my business at the same time? Okay, so here's one example in graph form. I hope you guys like numbers. It's a lot of numbers tonight. I should have warned everybody. We're going to look at this yellow line for a minute. The yellow numbers is, this was a client, he was set up, he was doing $20,000 a year through his policy. He's not out $20,000 a year. He put $20,000 in, but then he's got access to the cash value inside that policy. So in his case, the cash value line is the purple line right below it. And this is cumulative, okay? So he put 20,000 in year one, he could access 14 of it right away. Okay, now what happens, because you're capitalizing your system, so to speak, the first few years, maybe 2, 3, 4 on average, you can't get out the same amount you're putting in part because it's insurance, you're paying the charges of insurance. However, on average, somewhere between years 2 to 4, the cash value begins growing more than you're paying in. So you see here in his case, let me go back. A lot of people go, well, hey, I'm 4 years in, I've paid $80,000 into this, and I've only got 66 available. It's not a very good return on my money. Well, I say, well, no, wait a minute. You had 44,000 the year before, you put 20,000 in, you should have 64,000. Well, already in his case, by year 4, it's growing more than he's paying in. And then on average, somewhere between year 7 to 10, just depends on how we structure it for the client. Somewhere between year 7 to 10, the cash value exceeds, the cumulative cash value exceeds the cumulative outlay of the policy. So in his case, you'll see, 9 years in, he's got 200,000, he's 10 years in, 200,000 in, but he's got 221,000 in cash value. This top line is the death benefit, which we're not really going to cover, but just so you know what that top number is. So here he's got 200 and 221 available. And this is money he can access year over year over year throughout his life, this cash value. And you access it as a loan inside the policy. So you borrow against it, is what we say. Fast forward for this guy, he's going, so he started at 25. He went for a long time. By 54, he will have paid a cumulative 452 through the policy, but now he's amassed 1.1 million in cash value. The purple again is cash value. You can access it along the way, so you're borrowing it and pay yourself back over time. So I'm going to use that same car example. Say even by the second year, if he needed to buy a car, he could go out and buy a car. And then he could pay cash. He could pay the dealership cash. He'd borrow it from his policy. And he could set himself up with a 5-year car payment to pay himself back. Either way, he was going to have a car payment, right? He was going to buy a car, and you're going to have a car payment. So this is not lost money, right? It's not money you can't touch. It's not money you're penalized for touching. You want to borrow it, and you want to make that money make money, especially if you're in business, right? You take that money and you make it make money, and then you pay it back so that you can use it again and again and again throughout your life. Anyway, fast forward 54, he's got 1.1 built up. By retirement, age 70, he's got just over $500,000 paid into the policy, 2.6 million in cash value available, and a whopping $4.3 million death benefit. Now, the math of this is such that by retirement, he could actually borrow about $100,000 a year out for retirement, never pay it back, and it's tax-free. Okay, so I'm going to circle back to that example, a little bit larger number here in a minute, but you'll see here in a minute how this can play out. Now, I've been talking about a borrowing, right? So let me define the terms. Borrowing from or against the policy. I'm saying borrow against the policy. Let me explain what's going on. So, you is you. Emeritus is our insurance carrier that I use the most. Private Family Bank is the cash value inside your policy, okay? So let's say you call the carrier, you say, how much cash value can I borrow against? They're going to look at your policy and they say, okay, we have this much available. You say, great, I'll take a loan for X amount. So what they're going to do is they're going to loan you their pile of money. They're going to charge you anywhere between 3.5%, 5% right now. Right now it's 4%. Because they're going to loan you their pile of money, but that's why your pile of money will sit and grow uninterrupted. Back to what I talked about earlier about uninterrupted compounding. Let me bring this back. Here's what we mean. I'm going to use this. This is the same graph we just looked at. This person has built up $600,000 in cash value by age 44. And let's say huge opportunity comes up. He wants to borrow all $600,000 of it at once. And he's not going to pay it back for 5 years. Well, he's going to continue paying premiums, but you see he has got this policy compounded growing so much, so fast. You see the yellow, remember, that's his cumulative outlay. So over a 5-year period, he only paid $26,000 in premiums. $26,425. His cash value grew $210,000. So we kid with him, say, Jordan, would you pay $26,000 to make 210 every 5 years? Well, of course you would. Anyway, so let's say he pulled 600 out. 5 years later, he keeps paying the premiums, paid the 26 in premiums over that 5 years. That cash value will still grow to that gross of 829,000. So in other words, if the minus the 600 you got out, So he'll still have $230,000 in there. So it grows uninterrupted. That cash value will grow as if the principal never left. And there is no other vehicle out there that will do that. And this is your money. You're not getting, you know what I mean? You're not, you control when you borrow against it, you use it however you need to use it. It's an unstructured loan, so you decide how long you're going to take to pay it back, how often, how much you're going to pay. That's what I mean by uninterrupted compounding. Let me tie this in. So let's say someone's got an RV park and they want to expand over time, right? So you got a larger park, you want to, work towards, you want to take over the banking function in your life. That's the point. You start your own farm. Sorry about that. I had a farm webinar recently. You want to fund your retirement and have a generational legacy. So this is what we call an illustration. This is what all the numbers plugged in start to look like. So we're looking at, this is the premium outlay for this person. This is the cash value that year, and so forth. But it's easier. I like it in graph form better. So here we go. Same type of scenario. By year 3, this person has paid. They had $25,000 saved up, and they were going to kickstart their own business. Or you've got $25,000 saved up, and you're going to boost. You're going to put it in and build some more RV spaces. Whatever you're going to do to expand your park. So 3 years in, you've got 75 in to the policy, but 68 available. But now by the year 4, it's growing more than you're paying in. By year 7, you've got 175 in, 177 available. I'm saying you, but that's this client, right? By age 65, they will put a little over $500,000 in and 1.4 in cash value available. And you see, in this case, we stop funding the policy at a certain point. So even if you're later, this is a 31-year-old that started. Even if you're 41 or 51, it's never too late to start, right? You can start something, and we structure it to you and your situation. What are your goals and objectives? What's your financial situation? What are we trying to accomplish? Anyway, by retirement, we stop funding the policy. That's why the outlay doesn't change, but that the money is still compounding inside of the policy. So it grows from age 70 to 75, grows from 1.7 to 2.1. And mind you, all of the gains, you paid $560 in, 1.7 accessible. The gains are not taxable because you will never access it as pure income. You will always access it as a loan, and the IRS does not tax on loans. That's why by retirement, you can borrow against the policy for retirement, but the growth is outpacing what you're borrowing anyway, and so you never have to pay it back, and it's a loan. And then the loan balance you've accrued through retirement will just get wiped out via the death benefit. So let's say year 1, you had 25 in the policy. You could actually borrow 18 of it right back out. So you borrow it, you're going to turbocharge your RV business. You're going to put it into a tiny house. If you're doing the tiny house thing, we'll build a couple of more sites. Maybe that end of year profit gets you about 45. So you take some of that profit and you pay back the original 18 loan, and you pay some of the next year's premium. Now by the second year, this is from that graph. We've got 43 in cash value built up. Say you take a $25,000 policy loan that year, and then say that makes you $80,000 that year, because now you've doubled everything, right? Pay back the loan, pay the next year's premiums with it, and you've got an extra 30. But that's by the third year, right? We have to think long range. This isn't a get-rich-quick scheme. Now, just using money from the policy to make more money is paying for the policy. And by the third year in this example, right, they're profiting above and beyond that. And so it's self-funding itself. It wasn't about how much extra money can he save up to put in a policy, or how much did he have in savings to use on this. Uh, Rinse and repeat, and you can do this year over year over year. So say you've built up a couple 100,000 in cash value, and let's say you take a loan, you borrow 200,000 out, and you're going to keep it out for 10 years. Let's talk houses. Let's say I took 200,000 out and I put a down payment on 4 houses, 50,000 down. 4 $200,000 homes as rental properties. Now with my mortgage, let's say I'm also each house is going to pay back that 50,000 that it borrowed over a 10-year period. But I loaned myself the money, right? The down payment. So I want to recapture that down payment. Well, over a 10-year period, keep paying the policy premiums. This got $148,000 net growth after the cost of premiums in cash value. So not only will you have made money from the rental income, you recapture the principal amount, and you have an additional $148,000 in cash value growth by the end of that 10 years. And now you can take the 148 and the 200 all over again and do it even bigger. You don't have to wait that long even. You can do it a couple years later. But you see, the principle is it's always growing. And if you're utilizing the cash value to make more money, you have this positive arbitrage situation where you're making money in 2 places at once. And then you're constantly above that, recapturing that principal amount to spend over and over and over again. You see that? Okay. So this is just showing, this is the cash value that's accumulated over a 20-year period. The 675 right here. And then by age 60, 1.1 million. This is how much they paid into the policy, 529,000, 1.1. And now they're ready for retirement. Say they've been utilizing this throughout their life. They've been making themselves make money. Their policy's growing. Life's good. Approaching retirement. They say, hey, 65, I'm going to retire. We've built up 1.4 million in cash value in the policy. Okay. So what we're going to do is plan for retirement at that point. By age 70, they built up 1.7 million. And now here's where we say, hey, we're going to stop funding the policy. So you see this on the left. So we can flip a switch on the policy that says we're not going to pay any more premiums. And now the cash value, you'll notice, is going to keep growing. This cash value column on the right-hand side. But now we're saying, hey, we're going to borrow from the policy for retirement, a tax-free loan each year. I'm going to borrow $100,000 a year and live on. So this person can take $100,000 a year. So I just showed it out for 20 years, all the way to age 90. That's $2 million tax-free they would have lived off of because they're borrowing it from the policy. If they made it 20 years, $100,000 a year, factoring in the interest, remember we talked about earlier, that would cost them, it would still pay 1.4 million in death benefit at the bottom here. So let me cover that again. Throughout their entire life, paid 590,000 or so in this example. They then used that cash value throughout their life to make more money with. They became the bank. They took over the banking function in their life. $2 million lived on over retirement. 1.4 is still going to pay out to the beneficiary, whoever that is, your children, a trust, whatever. And now this next part is my personal favorite part. It's the legacy component of it. And I'm not just talking about death benefit and, oh, you're going to give the next generation a large death benefit. How do you keep this going generationally, right? You teach the next generation the same stuff and set it up for them so that it can keep churning throughout multiple generations. Well, let me show you. So let's say you started. You're using the policies now throughout your life. Okay? Insure your kids early so that their cash value starts growing on their policies. Upon your death, one option, you fund the family trust, the family bank. And now all of a sudden this trust becomes like a bank. And you've taught the kids how to utilize that. The trust can take ownership, can own these policies on the kids also. The kids have been building up the cash value in their policies, so they've got that available as well. They insure their kids, right? And the second line kids, their death benefit's going to fund that family trust even more. And the grandkids will fund the family bank. And the next generation after that. And that's how you get this generational legacy. We hear about the Rockefellers. They do something very similar. They're 6 generations in and still rolling. Because they're teaching each generation. It's not about how rich are you, although they had an advantage from that. It's about how someone has to start it, right? And you start something like this, you can set something up that can last for generations. You know, and this is one of my favorite quotes: what you leave behind is not what's engraved in stone monuments, but what's woven into the lives of others. You know, how can we do something that's going to last far beyond the real estate we own, the RV parks we own, you know, all that stuff? Someday it's going to go away. You know, we always hope, you know, our children will take over our businesses, but what if they don't? But what if they have something greater for them, you know? And we've been able to help them along by having this private family banking system that they can then borrow from the family bank for a car or for college instead of going to an outside bank, right? How nice would it be to have the money in-house for student loans? It's a big problem right now. Or a car loan. Or anything else you're going to finance. Or just the family vacation. Quit using your credit cards. Okay, so like I said, it's a very customized approach. We talk goals and objectives, understand your financial situation. It's life insurance, so there is an application process usually. Do a lot of just strategy planning, make some recommendations, and then it's up to you to implement it. So now is the time. I never met a person who said, gosh, I'm so glad I waited a couple years to start this. You know, it's always, man, I wish I would have started this sooner. Always. And so I tell you, don't procrastinate. If it's something you want to look into and explore more, let's talk. There's no financial obligation. I don't charge for the education and the strategizing. I love teaching this stuff. I will help you come up with a strategy, and then your money starts your policy. Okay? You don't pay me like you pay a financial advisor per se. Okay? So the money you spend goes to your policy, and you will build up your family bank that way. But my number's on the screen, my email. I will also email everybody who signed up tonight with a link to watch this webinar again, a link to meet and chat and just talk through any questions you may have and see what's out there. So if you have any questions, feel free to pop it in the chat. Feel free to schedule an appointment with me and let's chat, see what your situation looks like. I'm going to stop talking for a sec, but thank you guys for coming tonight, and we'll hope to talk to you guys soon. Yeah, one of the questions is how much is it to get started? And that's kind of back to what I was talking about. Everybody's situation is different. It's such a customized approach that literally I have someone doing $200 a month into a policy because that's what makes sense for them. It's a starter policy. It's a great place to start. And I have someone doing 300,000 a year because that's their financial situation. So it's really what's appropriate for you, what makes sense. I had a meeting earlier today. By the end of the discussion, it was, hey, finances are not in a place where you should start something right now. But, we talked through a plan and we're going to reconvene in 6 or 12 months and see how they're doing and see if they can get some of that debt under control and start something then. So it's a very customized approach. There is no like, well, how much to get started. Yep. Yeah, love to meet. And we'll chat. Okay, guys. Well, thank you very much. Again, calendly.com/JasonKPowers, or you can text me if it's easier, and I'll text you a link, 303-250-1755, or feel free to email me, jpowers@unbridledwealth.com. You can also check out my website. I didn't put it on here. It's 1024wealth.com, 1024wealth.com. And there's a lot of resources on there for you as well. Thank you, guys, and I hope to talk to you all soon.